Welcome back to our Investing 101 series. Today, we delve deeper into the intricacies of equity investment, aiming to equip you with a comprehensive understanding of how to navigate the dynamic world of stocks and shares. We'll explore the fundamental concepts, valuation methods, and strategic approaches that form the bedrock of successful investing. Additionally, we'll discuss the psychological aspects of investing, the impact of global economic trends, and the importance of adapting to changing market conditions. At its core, equity investment represents a stake in a company's ownership. By purchasing shares, you become a part owner, entitled to a portion of the company's profits and assets. This fractional ownership is the foundation upon which your investment journey is built. Understanding the different types of equity, such as common and preferred stock, is crucial for making informed investment decisions. While common stock offers voting rights and potential dividends, preferred stock typically provides a fixed dividend with less volatility, but without voting rights. Valuing a stock involves assessing its intrinsic worth and comparing it to its market price. Fundamental analysis delves into a company's financial health, competitive advantage, and growth prospects to determine its intrinsic value. This process often includes analyzing financial statements, understanding the business model, and evaluating the management team's effectiveness. Discounted cash flow, DCF, modeling, relative valuation, and comparable company analysis are common techniques used in this process. However, market sentiment, influenced by investor psychology and macroeconomic factors, also plays a significant role in determining stock prices. It's important to recognize how external events, such as economic reports or geopolitical developments, can sway investor confidence and impact stock prices. Successful investing is a marathon, not a sprint. Adopting a long-term perspective allows you to ride out market fluctuations and benefit from the power of compounding returns. This approach is particularly effective when investing in high-quality companies with sustainable competitive advantages, often referred to as moats. These companies are better positioned to withstand economic downturns and continue growing over time. Dividend-paying stocks, for example, not only provide a steady income stream but also often reflect a company's strong cash flow and financial health, contributing to potential capital appreciation over time. Reinvesting dividends can further enhance your returns through the power of compounding. Risk management is paramount in investing. Understanding the various types of investment risk, such as market risk, company-specific risk, and interest rate risk, is essential for making informed decisions. Market risk, or systemic risk, refers to the potential for the entire market to decline, while company-specific risk, or unsystematic risk, is tied to the performance of a particular company. Interest rate risk is particularly relevant for bonds and other fixed-income investments, as rising rates can erode the value of these assets. Diversification, spreading your investments across different asset classes and sectors, is a cornerstone of risk management. By constructing a well-diversified portfolio, you can reduce the impact of any single investment's performance on your overall returns. It's also important to consider diversification not just within equities, but across different types of assets, such as bonds, real estate, and commodities. To further mitigate risk, the stock market is a complex ecosystem where supply and demand determine stock prices. Understanding market microstructure, including order types, trading mechanisms, and market participants, can provide valuable insights into price movements. For instance, knowing the difference between market orders and limit orders can help you execute trades more effectively. Technical analysis, which studies price and volume patterns, can be used to identify potential trading opportunities. Chart patterns, such as head and shoulders, or technical indicators, like moving averages and relative strength index, RSI, offer insights into potential price movements. However, it's essential to combine technical analysis with fundamental analysis for a comprehensive investment approach, as relying solely on technical signals without understanding the underlying business can lead to suboptimal decisions. Behavioral finance recognizes the impact of psychology on investor decision-making. Common biases, such as loss aversion, overconfidence, and herd mentality, can lead to suboptimal investment choices. Loss aversion, for example, can cause investors to hold on to losing investments too long, hoping to recoup losses, while overconfidence might lead to excessive trading and risk-taking. Herd mentality can drive investors to follow the crowd, often buying high and selling low. By understanding these biases and developing effective strategies to mitigate their influence, such as setting predefined investment rules or using stop-loss orders, you can improve your investment outcomes. It's also crucial to remain disciplined and stick to your investment strategy, even when emotions run high. Market efficiency is a theoretical concept suggesting that all available information is reflected in stock prices. While it's a useful benchmark, it's important to recognize that market inefficiencies can exist. These inefficiencies create opportunities for active investors to generate alpha, or returns above the market average, through thorough research and analysis. However, passive investing, which involves tracking a market index, can be a suitable strategy for many investors, especially those who prefer a more hands-off approach. Passive strategies often benefit from lower fees and the long-term growth of the overall market. That said, even passive investors should be aware of their asset allocation and rebalance their portfolios periodically to ensure they remain aligned with their investment goals. Investing in different asset classes, such as stocks, bonds, and real estate, is crucial for building a well-rounded portfolio. Each asset class has its own risk and return characteristics, which can help balance the overall portfolio. For example, bonds typically offer more stable returns and lower risk compared to stocks, making them a good counterbalance in a portfolio. Asset allocation determines the proportion of your investments in each asset class. Regular rebalancing is essential to maintain your desired asset allocation over time, especially as market movements can shift the balance of your portfolio. Additionally, considering alternative investments, such as commodities and hedge funds, can help diversify your portfolio further. Though these assets often come with higher risk and complexity, it's important to fully understand any investment before adding it to your portfolio. Fundamental analysis involves a deep dive into a company's financial statements to assess its profitability, solvency, and efficiency. Key financial ratios, such as price to earnings, P/E ratio, return on equity, ROE, and debt-to-equity ratio, provide valuable insights into a company's financial health. The P/E ratio, for instance, can help gauge whether a stock is over or undervalued relative to its earnings, while ROE measures how efficiently a company generates profits from shareholders' equity. Industry analysis helps identify attractive sectors and companies with competitive advantages, such as strong brand recognition, technological leadership, or cost efficiencies. Understanding these factors can help you make more informed decisions and identify potential investment opportunities. Top-down and bottom-up investing approaches offer different perspectives on stock selection. Top-down investors start by analyzing macroeconomic trends and industry outlook before selecting specific stocks. This approach allows investors to capitalize on broad economic trends and sectoral shifts. Bottom-up investors, on the other hand, focus on individual companies with strong fundamentals, regardless of overall market conditions. This method is particularly effective for identifying undervalued companies that may be overlooked by broader market trends. Both approaches have their merits, and combining elements of each can provide a more balanced investment strategy. Investing involves inherent risks, and it's essential to have a clear understanding of your risk tolerance. Risk tolerance is influenced by factors such as your financial situation, investment goals, and time horizon. By defining your investment goals and time horizon, you can create a portfolio that aligns with your risk profile. For example, a longer time horizon typically allows for a higher allocation to equities, which may offer greater returns but also come with higher volatility. Regular monitoring and adjustments are crucial to ensure your portfolio remains on track, especially as your financial situation or market conditions change. Reassessing your risk tolerance periodically can help you stay aligned with your long-term goals. Ethical investing, also known as sustainable investing, considers environmental, social, and governance (ESG) factors in addition to financial performance. Many investors seek to make a positive impact while generating returns. ESG factors can influence a company's long-term success, as companies that prioritize sustainability may be better positioned to manage risks and capitalize on opportunities. There are various investment options available, such as socially responsible funds and impact investing, which specifically target companies that meet certain ethical criteria. Incorporating ESG considerations into your investment strategy can not only align your portfolio with your values but also potentially enhance long-term returns by focusing on companies that are well-managed and forward-thinking. Building a successful investment portfolio requires a combination of knowledge, discipline, and patience. By understanding the fundamentals of equity investment, conducting thorough research, and making informed decisions, you can increase your chances of achieving your financial goals. Remember, investing is a long-term journey, and market fluctuations are inevitable. Stay focused on your investment plan and maintain a diversified portfolio to weather market storms. Additionally, it's important to continually educate yourself, staying informed about new investment strategies, market trends, and economic developments. This ongoing learning process will not only help you adapt to changing market conditions but also enable you to make more sophisticated and effective investment decisions over time.